Mortgage insurance. Did you know that you can actually get around paying monthly mortgage insurance with less than 20% down? It's nothing new. The problem is not a lot of lenders are actually going to tell you about it. So if you're putting less than 20% down, sweet spot being 10%, if you put 10% down and you have a pretty good credit score, you can do what's called a buyout. It's a one-time payment for mortgage insurance that avoids you ever having to pay it monthly. That premium that you're going to pay, this buyout amount, is very heavily based on your credit score. If you have a 720, 740 or above credit score, this premium is give or take about 1% of what you're borrowing if you're doing 10% down, and that 1% can be financed in, paid in cash, paid by the lender, or paid by the seller. It's a great hack to keep an extra 10% in your pocket and still get around monthly mortgage insurance. Just like anything else, you still have to do the math to make sure it's the best play for you. Monthly mortgage insurance can be pretty cheap. People are often surprised by how low it can be, especially with a high credit score. So you do want to outweigh whether or not it makes sense to pay a monthly premium or do a buyout, and that is largely influenced by what your plans are staying in that loan and staying in that home even. Typically, I do not recommend a mortgage insurance buyout if you plan to sell or refinance your loan in the next 2 to 3 years. It's also a great hack if you're looking to increase your qualification a little bit. If you do a buyout, that means that there's no monthly premium, leaving more room in your debt ratio to potentially lend you a little more money. For more home buying tips, be sure to follow us.